All right, hey everybody. This is a another version of the masterclass group coaching offer writing workshop. And what we're going to do here is we're not going to get to the offer writing stage. We're not going to write the LOI, but we're going to analyze this particular property, and I'm going to show you, all the things you need to be aware of when you're analyzing a deal like this. So this particular property is called Patriot's Hollow. It's located in as you can see here, let me just slide up a little bit, Conway, South Carolina. Okay, take a look at this. It's a beautiful property. It is gorgeous. It is virtually new. It is the type of property that you would want to own, the type of property that you would want to live in. Really nice spot. The problem is that regardless of how nice it is, if you overpay for the property, you've killed yourself. You will never get that money back. And the broker's job is not to help you in any way. The broker's job is to maximize the sales price for his client and for himself. The only people that win with a higher sales price are the seller and the broker. You lose. So in this particular package, you are going to see how he has just done everything he possibly can to trick you into paying too much for this property. And I'm going to walk through all the different things so that you can see exactly what you need to be aware of when you look at these types of properties. Now, so am I jaded? Am I looking at this the wrong way? Am I, do I think so poorly of brokers? The answer is yes, I do. All right. They are not your friends. I am your friend. And I will help you every step of the way to make sure that you don't overpay for properties, because brokers don't really care about you. You're just numbers on a page to them. They get to the closing table and they get their check, and you never speak to them again. And that's it. That's the name of the game. All right, so let's start taking a look at this particular property. And when I post this deal to the membership site, I will post this PDF along with the Excel worksheet for the cash flow analyzer. Okay, obviously here, let me see if I can minimize this so we can see everything on one page. There we go. Okay. All right. So here is the broker's get out of free jail card. This is where they say, hey, don't blame us if this material is wrong. You're responsible for doing your own due diligence. Don't mess with us. That's all well and good. From a legal standpoint, they can probably try to disclaim as much of that as possible. But at some point, if it becomes that they, intentionally deceived and acted in bad faith, then they have another problem there, one that they can't disclaim away. But man, that takes, you never know, that takes huge litigation costs to even get to that level. So you really want to make sure that you do the proper job of the due diligence in order to make sure that you've done everything correctly. All right, so here's a table of contents. Look at all the stuff they give you. They give you the executive offering summary. They give you the financial analysis and the pro forma and any financial assumptions, investment highlights, location maps, aerial maps, floor plan, property photos, property, blah, 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 blah. All I care about is what? The financial analysis and the financial assumptions. I don't care about his investment highlights. His investment highlights are not necessarily my investment highlights. I don't care about the pro forma, but I do want to see what he thinks this property can do in the future. All right. So let's move on quickly. Let's take a look at what this property is. Now, it says right here, Patriot's Hollow is a student housing complex. Okay. That's interesting. It's a student housing complex. This is the first time I've seen that. And look up here under the the front thing. Do you see anywhere where it says it's a student housing? He says it's 101 beds. Okay, that's fine. Show me the lease. I want to see what the lease says to show that we have people paying by the beds in those places. All right. Across the street campus from Coastal Carolina University, located in Conway, South Carolina, 51 units, 101 bed complex. Featuring 1, 2, and 3 bedroom unit mix, was built in 2009, relatively new, and delivers a premier living experience for students. Patriots Hollow is comprised of three-story buildings comprised of wood frame construction, vinyl siding, and asphalt shingle roofs. All sounds pretty good. Each unit consists of beautiful wide plank hardwood style laminate flooring in the main living areas and carpet throughout the bedrooms. Okay, I'm liking this. The newer appliances include washers and dryers in each unit. Okay, washers and dryers in each unit. That means I'm paying the water. These people can run the washer dryers all they want. Should be no laundry income on the income and expense statement because the people are using them on their own. So the water is going to be paid for by me, and I'm going to have to be paying a lot of the water. Oversized closets, ceiling fans, decks in each unit round out the beautiful accents of these centrally air-conditioned units. Throughout the beautifully manicured landscape, you will find several outdoor grilling stations, a basketball court, and a dog walk area with plenty of parking. Okay, beautiful, really nice. Students are just short bike walk ride. Current occupancy for the 2015 school year stands at 100%. Okay, so that means that they've got 100% of the property is leased. Does that mean they're going to collect all of that rent? Not necessarily. But that's a good start. That's a good thing to see because look at, he's talking about for the 2015-2016 school year. So from September through May or June, this place is 100% leased. But notice that he says leased for the school year. What happens in the summer months to this property? That's the question. All right. Now, the other thing too is if it's not a student property now, don't expect it to be a student property when you buy it. All right. If the broker is trying to sell you on this property as being a student-run property, it had better be a student-run property now, student-owned property now, student leased property now. Because if it isn't, you're not going to make it that way. It either is or it isn't. If somebody comes to tell you like, hey, this property is 1 mile down the road from University of Kentucky, it's a student property. And then you go and you find out of the 200 units, only one student lives there. This is not a student property, and no matter what happens, you are not going to turn it into a student property. Okay, it just will not happen. So make sure you know what you're buying, and don't think that you're going to change that leopard's spots because now you're the owner of it. All right, it doesn't work that way. It either is a student-run property today or it isn't. All right, then it tells about Coastal Carolina University. Let's see what they tell us over here. Number of units, 50. Number of beds, 101. Built in 2009. The price per unit. Now check this out. Price per unit, TBD, to be determined. Cap rate, TBD, to be determined. Financing, TBD, to be determined. What does that tell you? Broker's not setting the price. Broker's not telling you what the cap rate is. If the broker told you what the cap rate is, you'd automatically be able to figure out what the selling price is, right? Because you know the three variables, you know two of them, you can solve for the third. In this particular case, he's not telling you the cap rate and he's not telling you the purchase price. You're going to have to figure out the NOI, and you're going to see what this guy did. Typical broker move, but you're going to see what he did with the NOI. He is doing everything he possibly can to drive the price of this property so incredibly high so that you overpay for it, and I'm not going to let you do it. So we're going to be very, very conservative in our analysis. Now check this out. Remember, according to his package, I only need to go to about the 6th page, and I have everything I need to make a decision on this particular property. And let me I'm logging in because I'm going to need to jump over to a screen in a second. Okay. Check it out. He's got 2014 actuals right here, and he's got year 1 pro forma, and he's got the income, loss to lease, vacancy, concessions, model employee unit, bad debt, all 0. So it comes up with a market rent of $515,040. And look at no vacancy loss, no concessions, no model units, no employee units, no bad debt. Comes down to effective rental income of $515,000. What's this guy doing? Essentially what he's doing is he's saying, how much money did the property make last year, take in last year? And the answer is $515,040. Okay. All right. So from there, we're going to start netting things out. Repairs and maintenance, salaries and payroll. Let's take a look at some of these numbers. Repairs and maintenance, $600 per unit. Wow, for a property built in 2009, that's pretty steep. But remember, we're talking students. They might be trashing a lot of this stuff. Salaries and payroll, he's got it right at $1,000. Okay, 51 unit property. Man, that's, what do you have on a 51 unit property? You have one person? You have 1.5 people? It really depends on what's going on. In this particular case, because it's 100% leased, you don't need a leasing agent. You need one maintenance guy. That's all you need. And it should cost you about $52,000 or $1,000 per unit per year. General and admin, 124, that's fine. Marketing, 113. We can cut that one way back. It's 100% occupied. Contractor services, 636, okay, per unit. Utilities, $1,204. $1,204 per unit per year. That's almost $100 per unit per month. $100 per unit per year. Is this a tenant paid property or is this an all bills paid property? Well, it depends on what they're paying for the $100 per unit per year. So we're going to go back and we're going to check that out. Now, take a look at the management fee, $20,000 on 50. So what is that, about 5%, 4%? I think it's about 4%. Hold on, bear with me, folks. I'm just trying to do a little math here. And I know you really smart people out there have already got this figured out. Yeah, about 4%. So a 4% they're using for the management fee. And look at this insurance number, $679 per unit per year. That's outrageous. That's very, very strange, especially in a place like Conway, South Carolina. Why are they paying that much for their insurance? That just seems crazy. And I wonder if it has anything to do with the fact that it's a student-run property. All right, so let me see. That's what we've got here. Those are the expenses. Now down here, he's going to give us the unit mix. 1 bed, 1 bath, 750 square feet, 6 units, $700 per month rent. Totaling, you add up all the other ones, totals $531,000 is the gross potential rent. Now, look at this one, 2 bedroom, 2 bath, $843 per rent. Okay, let me ask you something, folks. What do you know about the rental rates in Conway, South Carolina? You might not know anything about the rental rates in Conway, South Carolina. You might end up having to go and figure out, geez, is that right or not? Well, let's take a look, okay? Let's jump on over to one of my favorite web pages, rentometer.com. Now look at, I got 300 Patriots Hollow. It's already in there. We said it was 1,000, or what do we say? It was 843. What do we say? Hold on. 1,000 units, 843 for 2 bed, 2 bath. Okay, cool. Here we go. 843 for a 2 bed, 2 bath. I put in the address. I put in the rent that he told me they're getting for 2 bed, 2 bath. I put in the number of beds, and I hit analyze my rental income. Now watch this gauge right here. Watch this. Here it goes. Boom. Oh my gosh. Oh my gosh. Your rent may be way too high unless your apartment is in top condition or has more amenities than most. Does this have more amenities than most? It's got a grill. It's got a walkway. It's a place you walk your dog. It's got a basketball court. Are those great amenities? Heck no. Those are nothing. Is it in top condition? Well, it was built in 2009, so it's not brand new. There have been at least 6, potentially 6 people, on a yearly rent that have lived in my unit before me, and all of their crap has gone on in there before me. So 843 is really high for this. Look at the average rent is 637. It should be right here, but I'm at 843. What does that tell you? It tells you this property is not as great as you think, because the guy is pushing the rental income like you can't imagine. Now, keep in mind that this could be because he's raising money by the bed. Okay? All right, so he's raising money by the bed. If he does that, he's going to get more money than the market. And we all know that. And that's why we like student housing. But if he's not, if he's charging that rental rate for a regular 2-bedroom lease, then he's way over market. And that's a problem. That's not a loss to lease figure. That's a gain to lease figure. And banks don't like that. I just had to take a little swig. Okay, let's take a look at Look at this. Number 2, loss to lease is not tracked by the current ownership group. Oh, really? I just did. Took me 2 seconds. I went to see what the market rents are, and I went to see what you're getting for the rents. And the reason why you're not tracking loss to lease is because there is no loss to lease. It's a gain to lease. You just don't want us to know, right, Mr. Broker? You want us to overpay for this property. Now check this out. Remember what we said, the 2015, 2016 vacancies, occupancy is 100%. But look what he put in here. The overall vacancy for this submarket is between 10 and 12% and downward trending. I don't know if downward means down to 5% or what. Thus, 7% vacancy is assumed in years 1 through 5, so downward must mean he's going to move into the single digits. 2% concessions are assumed for years 1 to 5 to remain consistent with current market trends. But why? Why would you give out 2% concessions? You're at 100% occupancy. This will likely drop. However, 2% is assumed to remain conservative. That's being conservative. Why didn't you tell us what the gain to lease was? That would have been really conservative. All right, what else do we have in here? Bad debt is assumed to be 1%. No other income is calculated. Repairs and maintenance at $300 per unit. But remember, actuals repairs and maintenance was $600 per unit. So the property gets a year older and the repairs and maintenance costs get cut in half. How do you figure that? That doesn't make any sense whatsoever. Okay, the income loss to model units is assumed to remain as is. Okay, that's fine. Bad debt, there's no other income. Okay, repairs and maintenance. Salary and payroll. Property is pro forma to employ 2 part-time employees. At 51 units, there is an opportunity to be more efficient since there is also an assumed management fee. Okay, the payroll has got nothing to do with the management fee. Management fee is a fee you pay a company to oversee the operations of the property. Payroll is what you pay an employee to work day in and day out on that property. The two of them, they work together, but the costs for them are equally separate. So why this guy is doing that analysis is beyond me. So he's knocked his, last year they spent about $52,000 for the occupancy. For the payroll. This year he's expecting it to be $37,375. Guess what, folks? I'm going with the $51,000. This property is going to need a full-time maintenance guy to make everything run. So that's the key here. General admin, marketing. Marketing is Craigslist and a street sign. There is not a cost. Oh, really? What are they spending right here in marketing? Spending $113 per unit per year. That's $5,700. So much for not costing anything. Okay, contract services are assumed to be $225 per year. Why? This is a higher estimate considering an on-site maintenance tech. Well, you don't have an on-site maintenance tech, and you spent almost $600 for contract services last year. That just doesn't make any sense. Now, check out the utilities. A 1% increase to 2014 actuals. This includes cable for all units. So that big utility number that we talked about right here, where we were wondering whether it was going to be an all bills paid property, is $61,000. It's $1,200 per unit or $100 per unit per year. And now it's coming out to be, we have to dig down a little bit deeper to figure out exactly, it covers cable. Is that it? Hey, folks, let me tell you something. It might be it. Then we have management fee, 3%. Nobody's going to do it for 3%. We're going to have to go up on that. Insurance, pro forma reflects an insured expense of $288 per unit per year. This is confirmed with an in-place quota. They're telling me that I can go from $679 per unit per year all the way down to, where did insurance go? $288 per unit per year. That's a pretty big drop. And if it is such a big drop, why couldn't the owner do it? Okay, capital reserves, 200. We're not going to go into that. Okay, well, fully equipped kitchen, Wi-Fi, outdoor grilling, blah, blah, blah. Now, here's the information. This is where I'm going to start. I'm going to grab this information, the 1 bedroom, 2 bedroom, 3 bedroom, the total square footage, the rental rates, and I'm going to confirm the monthly gross, but I'm going to actually do that on my own. So, and then check this out: the utility, the electric paid by the tenant, water, sewer, and trash paid by the landlord. So as you can see here, it is not considered an all bills paid property. The tenant pays the electricity, but we pay our own electricity, I'm sure, and it must be put into this category like general and administrative, something like that, just so that we can make sure that we are calculating this correctly. Okay, so there you have it. Really, I don't really care all about everything else that's on this package down here. It means nothing to me. I'm going to hold it right here on this particular screen. Now watch what I do. So I'm going to jump on over to the cash flow analyzer. And as you can see, I've already changed the apartments, put in apartments. I haven't done anything else right now. 25%. So that's all I did on this particular screen. Then I'm going to jump over to the income. Now look at this: the 1 bed, 1 bath, 2 bed, 2 bath, 3 bed, 2 bath, 6 units, 39 units, 6 units. This is the cost, the unit numbers that they've given me: 7, 843, 1200, and I am using these numbers to create my top line number of 531,000. Okay. Then they come down, and there's no other inputs for the income. I'll just switch this up to 3. And you can see it shortens it. Up here, there's nothing fewer than 10. We only have 3 lease descriptions, and so we're going to keep it right there. It's 51. I see so many people come up here and say, oh, 51? Then I'll hit this number, 51. You got to scroll all the way down. No, it doesn't work that way. All we're talking about here are the lease description areas. All right, so right away we've got the gross potential rent of 531 based upon the 12%, that he told me about what was going on with the vacancy. This brings the effective rental income down to 467, which is probably too low. I think they made 531,000. I'm sorry, 513,000. Let's take a quick gander over there just so we can make sure. Actuals 515. So if we use their actuals, and I come back here and I'm going to say, well, this is, let's say 6%. No, 4%. Yeah. 511. Do a quick look here. What do we say? 515. 550. I'm going the wrong way. Yeah, right there. So the vacancy rate based upon what they actually collected last year is 3%. And there you can see the 515, just like he's showing over here, of 515,040. Pretty close, pretty close. All right, now let's go over to the expenses. Now over here in the expenses, now we've looked at all the expenses in the sheet here. I'm not going to go through them all right now because I want to, in the issue of time, I want to keep these lessons moving quickly. So the total expenses are 282,000. I'm going to put in 282,721. Let's call it down here under miscellaneous. 272. Oh gosh, it's pretty bad when you can't even remember just a moment ago. Let me see, where were we? 282,721. 282,721. Okay. We're running this property at about a 54.9% expense ratio. That's probably in line. The fact that the tenants are paying all of the expenses for utilities, that's definitely going to keep things under control. But if you recall, there are certain things in here that any new owner could get in there and really start to clean up. Let me see if I can show you. Let me see, the information is down here. Now, there's something about, that I can't remember now. Yeah, this is no big deal. This is all what's called broker fluff. And even the financials are broker fluff too, because they're not using them. Okay, let's go back over here. 282. Now, We now know what the NOI is, right? Because we know what the income was and we know what the expenses were, so we know what the NOI is on this property. But what we need to do is jump on over here to enter a cap rate, 6% or 8%. What do we think? I don't know Conway, South Carolina at all. I'd like to think that even though this is a nice new property, that the cap rate's going to be a little bit higher because Conway is a secondary market. It is not the place where investment dollars go running into. So, this one's going to be tough to get the money raised. It's going to be tough to make this thing happen. So the cap rates, and the guy that's been in there for years, he's been suffering from that same issue. So now it's going to become your problem. So you're going to buy this property at a lower cap rate than you expect, or a higher cap rate than you expect, because there's more risk involved in this particular deal. So let's take a look. We'll move down here. We'll put it at 4.5% interest rate. I'm going to go with 300 amortization. That's a 25-year lease, 25-year mortgage. And the reason why I'm going conservative is because of the fact that it is a secondary market, and banks are going to be much more conservative in a secondary market than they are in a primary one. We haven't figured out the purchase price of the property yet, so we don't know where we're going to sit in the Fannie Mae guidelines as far as a pre-review state or what have you. So I'm going to continue to be conservative and say that, well, okay, fine, we're going to go with a local bank on a 25-year amortization. So I've built in right now all the information regarding the purchase price, or the the financing and what have you. According to this, based upon the NOI that we calculated, the cap rate is 8%. And we're assuming 8%. That means that the property at the end of the first year is worth $2.98 million. All right, well, if it's worth $2.98 million, I'm not going to offer that. Let's offer $2.7 million. Less than 10% below the valuation at an 8 cap. Now, what happens here, folks? Broker comes back and says, oh, are you kidding me? This thing was built in 2009. It's beautiful. It's 100% occupied, blah, blah, blah. Okay, he thinks it's a 6 cap. What happens to my valuation? Now it's a 3.8, and I offered 2.7. So we're going to go with that 8 for starters, and we're going to see what happens. Let's take a look at the cash flow analysis. Here we go. I scroll down the financial measurements. Check it out. 1.72 debt coverage ratio. 14% cash on cash return. That's pretty steep, guys, okay? That's pretty steep, because to get a 14% cash on cash return on this type of property, there's there's a lot of stuff has to happen for you to be able to buy a nice asset like this at a, what do we say, an 8 cap that spits off a 14% cash on cash return. So, is this a good deal at the number we've calculated of the 2.7? Yeah, it's a really good deal, because now it's at 2.9. But what happens, folks, if the broker comes back and says, no, this thing's a 7 cap. Okay, then it's worth $3 million. So let's come up here and let's bump it up to $3 million. We bump it up to $3 million. Come down here to the cash flow analysis. It's still a 1.55 debt coverage, double-digit cash on cash returns. In 7 years, 16.24%. This is a nice deal, right there at that price. Even at that price. And this is why it is so important for you as an investor to know exactly what the cap rate is for this type of property. Because if we don't have your cap rate correct, then this property is going to, you're not going to value this property correctly. So you need to, the big wild card here in this particular deal is the fact that we don't know what the existing cap rate is. And that's something that you really need to know when you're doing this type of analysis, okay? So that is pretty much it. If anybody has any questions, at some point, I don't mean this to be, smug or coy or anything, but we are going to get into the, we are going to be getting into the drafting of the letter of intent. There are some videos already on the screen on the membership site that have the the cash flow analyzer, the letter of intent, and all the information you need in order to create your own deal and be able to draft your own letter of intent. But right now, we're just waiting to see how we can pick this one up next time, and we can draft the letter of intent, or I can actually throw one up on the website, on the membership site, just so that we can see exactly what's in there and whether we can make this particular deal work. So here's the problem. The guy doesn't tell you what the value of the property is. He doesn't tell you what the cap rate is. So right now, as you can see, we're guessing at the purchase price. Right now, we're saying $3 million. But the thing is, it's all about this cap rate. If this cap rate is not accurate, then we've just either overpaid or we could have stolen a property. So that's the issue you have to be concerned with when you're looking at these deals and you're looking at what the broker has put together. If it's a legitimate deal that has a history of financials and you know exactly how to you know how to figure out the cap rate is on this particular property, then you've got to do it, because otherwise you're going to be in big trouble when you overpay for this property. So all right, folks, that is essentially it for the call. If anybody has any questions, please just put them down here and or send me an email. You all know my email address, or send me a text message through WhatsApp, and I will definitely get back to you and make sure that you get everything you need. But this is going to be going up on the membership website, and then once it's done, this particular track, the compatibility menu, this particular website or email address will go up, and you'll be able to download all the documents and make sure that it works nicely for you. So hopefully that is it. Shoot me an email. But folks, I want to say I appreciate your time, and we'll all chat later. Thanks.